Sure. The word I have for the housing market right now is uncertainty. It feels like the market is holding its breath to see if the Fed is actually going to cut rates this year or if we're going to stay higher for longer.
You're listening to the Rich Dad Radio Show, the good news and bad news about money. I'm Adam Taggart, filling in for Robert Kiyosaki while he's speaking throughout Australia and New Zealand. Folks, if you don't know me, I'm the founder and host of Thoughtful Money. It's a financial media channel where I do a lot of long-form interviews about all topics related to money. I've known Robert and Kim for many, many years. Robert kindly asked me to step in for him while he was away traveling, and asked me to bring in whatever interesting guest I could find that would be of interest to this audience. And I think I've hit the bullseye here. So I'm joined by my good friend, Amy Nixon. She's a housing analyst who covers all things related to housing at her Twitter account, Texas Runner DFW. Amy, great to see you, and thanks so much for joining us today.
Glad to be here.
All right, Amy. Well, look, I know you don't give too many media interviews these days, even though demand for your appearances has gone through the roof since we first met each other. I remember back at our first time I got a chance to interview you, you had just gone viral with this tweet about the Airbnb Bust, which I believe is a term that you may have coined here. And since then, it's been wonderful just to see your star skyrocket there. And you know, when I do turn into Fox Business, I see you on there frequently these days. But anyways, congratulations on all the success. And today I'd like to start with your general update on the housing market. And then if we can, let's get an update from you on what's going on with Airbnb in the short-term rental market. I know there's a lot of people that listen to this channel who invest in real estate, and many who have bought properties to be short-term rentals or thinking about it. And I'd love for you to give them the latest on the land in that sector.
Sure. The word I have for the housing market right now is uncertainty. It feels like the market is holding its breath to see if the Fed is actually going to cut rates this year or if we're going to stay higher for longer. And those two different outcomes are going to have a pretty big influence on the real estate market, because when credit is tight, it's hard to get loans, particularly for investors. So I think that right now we're seeing some of the effects of these rates being held high, which means supply is starting to come back on market and pile up a little bit because that demand is just a little bit more crushed than the supply coming in. But we're also in a unique situation where we have pretty strong fiscal stimulus in the economy, and that has kept asset prices high. And because of those high asset prices, we see a little bit of a wealth effect where there are still buyers buying in several housing markets, even at these high prices and at these high interest rates. So this is going to be a really interesting year, and I think it's all contingent on what happens with those supposedly coming rate cuts.
Okay. And interestingly, since Fed Chair Jerome Powell announced that the Fed was now thinking about cutting and the rate hikes were over, inflation has proved stickier than I think the Fed would have liked, and stock market's gone crazy. Unemployment's still hanging really low. So there was a lot of questioning of why would you cut into that environment, right? Why wouldn't you keep rates higher for longer? Or as Larry Summers even suggested, even thinking about doing another rate hike, because nothing's breaking and inflation isn't under control, and that should be the Fed's primary priority right now. So anyways, as you said, it'll be very interesting, but my point is we may not even get those 3 rate cuts that the Fed has been guiding to and that the market is currently expecting. It could be 2, it could be even less. We'll find out. But let me ask you this though. So mortgage rates, I think right now, I think as of last week, the 30-year fixed mortgage rate was like 6.9%, right? Still very elevated, right? Certainly relative to, you go back 2 years or more, and it was a lot, the mortgage rates were a lot lower. But prices really haven't come down that much. In fact, nationally, in January, we just got the latest numbers for the S&P CoreLogic Case-Shiller National Housing Index. That rose 6% year over year, back to a record high, right? So I agree that the cost of debt is super important in the housing market. In fact, sort of famously, it has this relationship of rates go up and home prices go down and vice versa. It's supposed to be a seesaw. But we've had rates come up an awful lot and prices haven't really adjusted. And of course, I'm talking about the national average. There are certainly markets where prices have weakened. But what's your thinking on why that historic seesaw nationally hasn't really manifested this time?
My personal opinion is that we're in a state of fiscal dominance and that the market may be calling it out because we had so much fiscal stimulus over the last year that, like I said, all asset prices are at all-time highs right now. Stock market, crypto, home prices. There is a lot of money sloshing around the economy, and it's looking for assets to park itself in. And that is combined with historically low supply available in the market. And that's why we do see a divergence right now between markets that have been building, that have new construction, and markets that just have existing home supply. Because there's a different story between the building market, which prices have come down in that market, and the Case-Shiller, which is the existing home supply. It's just a simple matter of inflation still running hot and money is chasing goods, and there's more money chasing those goods. I mean, it can be as simple as we're seeing even now in the Bay Area, we're back to bidding wars. Look at all the people that have NVIDIA stock. I mean, the tech workers, their comp is pushing all-time highs if they're getting stock comp. So it's just the money is still there and it's chasing the assets. And there's only so much you can do with restricted credit when you're in an environment that has such loose fiscal spending.
All right. So it sounds like what you're saying is we've got this combination of money still flooding into the system, sloshing around the system. We have historically low inventory, right? I mean, that's sort of what happened, I guess, as rates went up, is the housing market froze in a lot of places, right? Transactions just really decreased. And so are we at the point where the affluent who own those assets that are appreciating because of the money sloshing around from all the stimulus, they can still buy? And so even though there are much fewer transactions, the transactions that are happening are predominantly the affluent buying because they can. And so that is supporting prices because that's the only really price action that's going on right now.
Yes. And I think, again, some of it also is a little bit of trying to get ahead of the market because those rate cuts are still on the table. And that means investors are looking at this scenario and they have still been buying throughout this cycle, even though rates were hiked. They did pull back from the volume of buying that they did in 2021, but they're still buying. And I think they're buying in anticipation of those rate hikes, wanting to get ahead of that, because what happens if we cut our rate cuts? If we cut rates in an economy that's running pretty hot with inflation running a little bit too hot, asset prices are going to moon even higher. And in that situation, you want to be getting your money into assets now and hope that you're right. Hope that those cuts do come. My opinion is that we will get at least a cut either in June or September, but I could be proven wrong.
You know, it's so interesting because on one side, it sort of sounds like I totally get the logic you just mentioned there, right? And that's everybody's general expectation. All right, Fed cuts rates, cost of capital comes down, asset prices can go higher, right? But in some ways, it feels like this magical thinking process where we raised rates, right, and did quantitative tightening at the same time, right? And still prices stayed high. In fact, like I just said, the Case-Shiller National Housing Index just hit a new record high in January. So we hike and prices stay high, and then we cut and then prices go higher. It's sort of the sense of like, no matter what happens, home prices just keep going up. And who knows, maybe that's what's going to happen. And if you're a real estate investor, you own property in that scenario, and that happens, you're totally happy, right? But at the same time, we've got housing, at least residential home prices at record levels of unaffordability, right? When you talk about, the average person earning the average salary being able to afford, today's housing prices. And so I guess my question is, like how much longer can this ever increasing, staircase continue to just go ever upward, no matter what's happening with policy? Is there some point of reckoning that has to happen, or are we just entering a marketplace where the affluent kind of own everything, and the regular people just increasingly are priced out?
The first answer that popped in my head was, as long as you've lived in California, um, at least
Yeah,
that long. I mean, there are
but we're
states like
hemorrhaging a ton of
California,
people that are leaving the state because they can't afford it. I mean, there is a price you pay, right?
and yet there's still bidding wars for properties in the Bay Area because there's a limited supply. And I think that it's most likely that we're moving into an era where affordability is just going to be harder for people. It's a more likely scenario that we're going to continue on the trajectory that we've been on over the last 15 plus years, which is that housing becomes a higher multiple of median income, and owning a home becomes more of a luxury item, and more people are in situations where it's cheaper to.
That's sort of an argument for, housing is going to be an asset of the affluent going forward, and if you can get yourself into housing, then you should, because the prospects for the appreciation of that asset look pretty good going from here. So I want to take kind of that general outlook, and then pivot towards the short-term rental market. And we're coming up on a break here in just a bit, so maybe we'll kick it off, Amy, and then we'll pick it up after the break. But so for those that have capital and are looking to invest it in the rich dad way, right, where they're putting it into assets like real estate that are generating cash flows and have long-term price appreciation potential. As we look to specifically the short-term rental market, again, I mentioned in the intro here that you famously sort of started your career with this, your analysis of what you've called the Airbnb bust. Are we past that, and is it game on to get into this space, or is now still not the right time to be deploying capital in the short-term rental market?
This is not a great environment for real estate investing, period, despite what I just said, because in my opinion, we're still going to be fighting relatively high inflation. So real estate in and of itself is an okay investment in that environment, and a short-term rental is probably the worst option of a real estate investment in that environment.
The worst option. Okay, that's good. So we'll dive into that after the break. Real quick, right before we get to the break, one question I wanted to ask you, Amy, was, I just sort of made that summary about, sort of an optimistic, sanguine outlook for real estate prices long term. What happens to that equation, let's say in the next year, if instead of a soft or no landing scenario, we end up actually having a hard landing, sort of a recession that comes with job losses and whatnot? Does that change the picture at all in your mind?
That's a worst case scenario. I don't see that happening in 24, but it's a possibility, I think, in 25. And in that situation, we would see declines in real estate prices pretty much probably nationally across the board. But there's a lot of variables that would have to come into play for that scenario to happen. So it's not my base case. But if we do land in a deflationary recession, then real estate absolutely is going to get hit because of the amount of debt that is in it, and the amount of people that have been speculating in it for the last 15 years of zero interest rate policy.
Okay, so generally positive long-term outlook, but you got to be careful and pay attention, because there are things that could happen along the way that could change the game. All right, Amy, we got to take a break right now, but we'll pick it right back up in just a moment here, and we will dive deeply into your short-term rental market outlook. Folks, you're watching the Rich Dad Radio Show. Thanks for listening.
Have you heard about the expanding influence of BRICS, Brazil, Russia, India, China, and South Africa, and its potential to severely impact the US dollar by possibly creating a new world currency? Even JP Morgan said, and I'm paraphrasing, the impact of BRICS would most likely be felt here in the US, where moving away from the dollar would cause our financial assets like our IRAs and 401ks to lose value. We agree with JP Morgan and many others. Now's the time to position yourself for stability, security, and wealth protection. So take it from Robert and me, whether you're a seasoned investor or just starting, we believe that gold should be a part of everyone's portfolio. Seize the opportunity to ensure your financial future with gold and do it with one of the best in the industry, Allegiance Gold. Allegiance Gold has done things right from the beginning, having earned 5 stars with TrustLink and an A+ with the Better Business Bureau. Allegiance Gold can help protect your IRA or 401k with physical gold and silver, or you can have it delivered securely to your doorstep. Get up to $5,000 in free silver on a qualifying investment when you visit protectwithrobert.com today. Or you can call 844-3-ROBERT. That's 844-3-ROBERT. Robert sounded the alarm in 2023, and his warnings came true. Unfortunately for many, it was a year of lost wealth, but it was the complete opposite for the billionaire class. Now the wealthiest 10% of Americans own over 92% of all U.S. stocks. But here's the good news. You can invest just as these billionaires did. Robert has said, if you want to be rich, do what the rich do. So you can diversify across the asset classes with what are called low correlation alternative assets. For example, fine art as a tangible asset that rarely ever changes hands, the fine art market is more resistant to traditional volatility. So the fine art component of these billionaires' portfolios are at less risk. And now you can add the same blue chip art to your portfolio from the comfort of your own home. You don't have to be an art expert to do so. Masterworks, our longtime sponsor, has an art investing platform with over 880,000 people on board and nearly $1 billion in assets under management. From their successful art sales, they have consistently delivered a profit to their investors, and you can even go check their numbers. Our viewers can skip Masterworks' waitlist by using the link in the description below. Hi everyone, I'm Kim Kiyosaki. Thank you for being with us today. As CEO and co-founder of the Rich Dad Company, I can assure you, Robert and I are both dedicated to our Rich Dad mission to elevate the financial well-being of humanity. And you are the humanity. We truly want you to succeed. When you succeed, we all succeed, and our mission grows stronger. With that in mind, I'm excited to extend a personal invitation to you to elevate your financial well-being by attending our exclusive free online wealth building event hosted by Robert. You'll learn what to focus on first to start increasing your cash flow immediately. You can reserve your seat right now by going to richdadonline.com. Just go to richdadonline.com. The event is 100% free and will help you achieve your financial goals.
All right, and we're back. Thanks for watching the Rich Dad Radio Show, the good news and bad news about money. Again, I'm Adam Taggart, filling in for Robert Kiyosaki while he is speaking throughout Australia and New Zealand. And I'm speaking here today with housing analyst Amy Nixon. In the first segment, we talked about her outlook for the general real estate market, which was fairly optimistic, at least for those that have capital to be able to invest in real estate these days. Now we were talking about her outlook for the short-term rental markets, the Airbnbs of the world, which Amy, at the end of the last segment, sort of gave us a peek that her outlook is not nearly as sanguine for that market as it is for the general overall housing market. In fact, Amy, you said it's not really a great time for real estate investing in general right now. Again, can you just give a quick synopsis of why?
Sure. In times of uncertainty, the move for investors is to extend duration. And what that means is you want to sort of punt out as far you can into the future when you're going to need to reprice. And that means if you've got a rental property, you want to have a 1 to 2 year lease with a locked in payment so that you're going to be cash flowing that property for 1 to 2 years, and you're not going to have it come up for renewal at any point where there might be uncertainty and possibly lower prices or more difficulty finding a tenant. A short-term rental is the exact opposite of that. It is something that is going to be vacant constantly throughout a year, and it's priced a couple $100 a night. Maybe somebody stays 3 nights. So you might find yourself in a situation where you've got a property that's vacant for months at a time. You keep dropping that nightly fee, and you can't find anybody that wants a vacation in it. You're still dealing with the carrying costs, and you still have to pay, the insurance and the maintenance on that property. So it's just not as great of an option as doing a longer term rental property.
Okay. All right. Well, look, the short-term rental market was on fire during the pandemic, right? We had people who were, getting stimulus checks. They had a lot of forbearance and other costs that they didn't necessarily have to pay. Once the lockdowns got removed, we had this, what was called revenge travel, where people were like, hey, look, I deserve to go out and have some fun. So that excess savings was being spent, with a vengeance. And as you know better than I, there were a bunch of people out there on the internet who were creating courses and, okay, here's how you can, retire from your job and build a quick portfolio of cash flowing, short-term rental properties to retire on. And so a ton of people went into that market. I think it was something like in the past 2 years, 50% of hosts or listings, I can't remember which one, but came online in just the past 2 years, right? But the tide has turned a little bit now, right? Where that revenge travel surge has come down. There have been a number of issues there. One just being that too many people probably bought Airbnbs, and there's just a saturation, an oversaturation of competition out there. What is it like on the ground right now in that market?
You covered a lot of it. There's a lot of oversaturated markets, particularly Joshua Tree in California is one, Palm Springs area, California. There's areas of Florida, Southwest Florida. There are just in Austin as well. There's just way too many Airbnbs, and there's not enough people that have a budget for vacation anymore. So we're seeing higher instances of vacancy, lower occupancy rates, and smaller investors have started to sort of what I had said, go bust. And originally, when I put that thesis forward, I had this idea in my head that it might mean that these would turn into long-term rentals or maybe even get back on the MLS and be sold to people to live in. But unfortunately, the first sort of step of this bust has been like selling to like, meaning Joe running his 2 Airbnbs that he's not cash flowing finds some LLC that's running 50 Airbnbs. And he's like, hey, I'll give you sort of a package deal for these 2 properties, but we're going to keep them as short-term rentals. And those 2 properties just get absorbed into this other guy's portfolio. And that has sort of helped stem, I think, some of the bleeding in this. The bust has sort of been more of like a slow unfolding up to this point. But we've got increasing regulations in many states. And we've got increasing backlash against Airbnb with the cleaning and the expectations and just the unknowns of, hey, if I'm spending $5,000 to take a vacation, then I want to know that my customer service is going to be good and not some random guy that I don't know if he's going to be a good host or not.
Right. And I want somebody making my bed for me in the morning, and I don't want to have these chores I've got to do before I leave the property. We've heard some nightmare stories, and I know these are the outliers, but not just like washing the sheets before you go, but I mean, I've heard like mow the lawn and crazy things like that. So, all right. And so, sounds like there's certainly like a changing of demand, right? Where people were willing to pay a lot and maybe put up with a lot in terms of, host requests and stuff like that. Now they're becoming much more picky. Now they're just not out as much, right? So probably the biggest factor, I take it, is that when these hosts, and many of them first-time hosts, got into the Airbnb market, they were doing their they're penciling out or their Excel spreadsheets and saying, oh, look, I'm going to make X amount a month from this thing. Now they're looking at their actual cash flows and they're saying, whoa, I'm actually losing X amount a month. I can't do this forever. So I got to get this hot potato, I got to give it to somebody else. Sounds like you're saying the first phase here is selling to larger portfolio holders of Airbnbs who presumably are still cash flow positive, at least across their portfolio of properties. Do you expect that to be the transition, or is that just a stage? In other words, will the next wave be portfolio holders, larger portfolio holders who start struggling because their portfolios now have flipped to net cash flow negative, and then maybe we get to the stage you were talking about where these things get converted into either long-term rentals, which presumably would start to flood that market and bring rents down even faster than they're coming down, or they get put on the market to be sold, and then maybe all of a sudden this very low inventory housing market we talked about in the first segment starts actually getting some real inventory behind it.
I think this is an interim stage, but again, I keep circling back to this. I think that it really depends on what happens with interest rates and with inflation, because I think if we find ourselves in a scenario where this is my base case scenario going forward, is I think the Fed is going to accept 3% baseline inflation and start cutting either in June or September. And what that's going to look like for the country is we're going to see asset prices moon. Top 10% of the country is going to have more money than ever. They're going to be vacationing. Bottom 90%, they're not going to be able to afford gas to drive to your $200 a night mediocre property in Florida. So there's going to be a lot more operators who are going to be in trouble if they did not do due diligence on realistic occupancy rates and realistically, like, is this a good property or not? Because when you've only got the top 10% of the country vacationing or affording vacations, I really hope you bought a very high-end luxury property, because the middle of the road stuff isn't going to cut it. Gone are the days of throw a dart at a dartboard, buy a piece of real estate, and be able to cash flow it easily. Those days are over in this kind of an inflationary environment. And it's going to take a lot more work for investors in real estate now to even find a deal that pencils and then to find occupants for that. So I expect to continue to see problems in this market, even if we don't have an actual recession, even if we do this scenario that I expect to happen, which is going to be kind of a no landing inflationary scenario.
Okay. And so let me underscore that, because that actually sounds really important for folks that are considering real estate investing, especially if they're considering buying in the short-term rental market. Is you're saying, look, we've had this period where rising tide raised all boats. And so you could, to use your analogy, throw a dart at any property, buy it, and you'd probably do okay. Now you're saying, and on my channel, when I interview economists and investors and analysts, they're echoing a similar message in the financial asset space, which is that everybody got used to just passive investing because all boats rose. Now you have to become much more an active investor, where you've got to really be paying a lot more attention and looking at specific companies. You can't just buy the sector ETF anymore and close your eyes. Sounds like you're making a similar point on the real estate market, which is you're really going to have to be very selective about the property that you pick. You're probably going to have to work harder to get it, because you got to really find a good deal, and other smart investors will be out there. So you'll be competing for the good deals and trying to avoid the properties that are not going to be good returners. And then, to your point, if you're in the short-term rental market, you've got to have a real marketing plan. Like, the fish just aren't going to jump in the boat anymore. You've got to really figure out how to, get your target customer into the house enough for it to cash flow positively for you. Did I kind of capture it right there?
Yes.
All right. So as we wrap up in these last couple of minutes, you mentioned here that it all really kind of depends on what happens with interest rates. And of course, that really all depends on what happens with inflation, because basically the Fed is controlling interest rates in reaction to what it thinks inflation is going to do. You actually think inflation is going to be secularly higher than we've had in the past, and that the Fed is basically going to give up, if I heard you right, its 2% inflation target and get comfortable with a higher one, like 3%. If that indeed happens, does that make hard assets like real estate desirable even at these current prices?
Real estate is an okay investment in that environment. Not short-term rentals for the reasons I just laid out, but just real estate. Sure. The word I have for the housing market right now is uncertainty. It feels like the market is holding its breath to see if the Fed is actually going to cut rates this year or if we're going to stay higher for longer. As much work, it takes a lot of work to run a rental property. It takes no work to buy an equity, to buy Bitcoin. And you can put in stop losses and minimize your downside risk doing that. So I just don't know why you would want to take on the risk of an illiquid market like real estate. Because if we do tumble into recession, like you mentioned earlier, it's very hard to get out and find a buyer. It's not like a market like equities or Bitcoin where you just go to your broker and you get out if things are going south. You have to find buyers. And that makes it a very risky investment in a downturn, which we can never rule out the possibility of a downturn. So I just think that there's better options out there. Do I think real estate's going to hold its value going forward? Probably. But is it going to keep up with even inflation? Like, is it just nominal, slightly go up and maybe real flat? Yeah, that's a possibility too. This is not the ZERP environment where we are going to be getting the crazy returns that we saw in the last 15 years.
All right, and I understand we're painting with a very broad brush here. They say price is what you pay, value is what you get. If you find opportunities out there that offer great value, obviously pounce on them. I imagine you would say. Don't words in your mouth, but you're sort of nodding as I'm saying this. So one thing about inflation is we didn't really get into that the cost of home ownership has really skyrocketed in recent years with inflation, right? We've had insurance companies jacking up their premiums. I mean, it's kind of an epidemic going on right now. Just to make general home repairs has gotten a lot more expensive because the contractor wages or fees have gone up so much. So to your point, there's a lot of people that are saying, look, especially in a market like the short-term rental market where the cash flows aren't so great anymore, it's pretty easy for somebody to say, my goodness, it would actually be a lot easier if I just put all my money into short-term T-bills right now and collected, 5.25%, and I didn't have to get woken up in the middle of the night with broken toilets and stuff like that, right?
Yeah, like I said, I think there's just better investment opportunities out there that are more liquid, carry less risk, and don't have any carrying costs. Because again, in inflation, you're going to be seeing the price of all the carrying costs on that property go up as well. They're going to rise with maybe any slightly nominal increases in price you get on the property. So it just makes it mediocre as an investment in terms of yield if you really want to maximize your yield.
All right. Well, look, we'll leave it there. Amy, thanks so much for joining us today. Folks, hope you've enjoyed this conversation. Amy, for folks that have enjoyed meeting you here, would like to follow you and your work, where should they go?
I'm on Twitter at TexasRunnerDFW. And my account just covers all housing. I do talk a lot about short-term rentals as well, but it's just a general housing and macro.
All right. And look, congrats again on all the success you've been having there. Folks, as a reminder, I'm Adam Taggart. I run the financial media channel Thoughtful Money, where I spend several times a week having even longer form interviews with folks like Amy and many other of the world's top experts in money and markets. To go watch those videos, just go to thoughtfulmoney.com, where I also offer free consultations with financial advisors that understand the world of what's going on in the markets and help people think through decisions like, hey, I'm thinking about buying a home either to live in or as an investment. They can help you think through all those important life decisions. If you want to schedule one of those free consultations, just fill out the short form at thoughtfulmoney.com. We also have a free newsletter there that you can sign up for. Amy, it's been a total pleasure. As a reminder, folks, you have been listening to the Rich Dad Radio Show, the good news and bad news about money. I've been delighted to sit in the chair here for Robert while he's been away in Australia and New Zealand, giving lots of presentations. Hope to see you folks soon. We'll be back on the channel at some point with another great guest for you on another topic that you, the audience, care a lot about. Thanks so much for watching, everybody.
This podcast is a presentation of Rich Dad Media Network.